Hello, this is Richard Bosshart speaking to you. I am a certified and experienced expat tax consultant. I would like to help you understand whether you have to file a tax return on your overseas income, and if so, how you want to go about it. You know, the CPA firms and the tax lawyers, they do great work for the corporations and the wealthy. But I can save you a lot of money in much lower fees and give you one-on-one service, and I will cover all the bases of how you can legally exclude your income earned overseas from a U.S. tax liability. Today, as the topic, I would like to discuss a little bit about who has to file and if that means you have to pay taxes. These are absolutely two different issues. The first one, who has to file, I'm going to read you the various categories, which it depends on your filing status and age. The lowest category is, that is the lowest income threshold, is for married filing separately, any age, and that's $3,650 of income. And the highest excludable amount, or the amount under which you don't have to file, I beg your pardon, is $20,900 for married filing jointly, both spouses over 65. And in between are the different other categories. Now, if you are over this threshold, you have to file an income tax return from overseas, and if you don't, it's criminal. So you can be grabbed when the next time you return to the United States. However, let's talk a little bit about having a tax liability. There are two general ways to exclude your foreign earned income. The first way is from foreign earned income exclusion. The tax regulations allow you to earn over $90,000. That's a figure for 2010 tax return, and they go up a little bit each year, without having any tax liability on that income. You even get an extra padding, perhaps, if your housing costs exceeded those that you would have had in the United States, and they usually are higher. So that's one way, and if you're over that amount of income, you have another way to go, and that is to calculate how much of your foreign taxes paid, which you must pay first to the local governments, is attributable to the excess income over this foreign earned income amount. And that can also be a credit against a U.S. tax liability. I might further add that there are some instances where you are liable for taxes. One is if you worked any days on a business trip in the United States, the income earned during those days is taxable. Another way is interest or dividends from bank accounts or capital gains from stocks in the United States. However, you are also permitted to have your full standard deduction, and that's quite a nice number, $10,000 or $12,000, depending on your filing status, or a little less if you're single. And so that can wipe away much more of any tax liability. So that's it for today, and I'd like to invite you to visit my website by clicking the link below and learn more information. Thank you.